Hey everybody, Marty Mazur. Good afternoon, June 7th, 2016. I think I can keep this one quick. This is your Thursday video, obviously. You're looking at weekly jobless claims. The number that was reported today for last week was 254,000. Now, the chart goes way back. You can see we're all the way back to the mid to late 60s. And I wanted to point out how incredibly low jobless claims have been of late relative to history. So here we are, folks, again with 254,000 jobless claims for the last week. You can see what they've done since the end of the last recession. And that 300,000 is kind of a line in the sand for a lot of people. That a lot of folks believe as long as we can stay under 300,000 weekly jobless claims, we're in pretty good shape economically. And we have to go back all the way to the 70s to actually find weekly jobless claims as low as they are right now. And folks, what I want to tell you, what makes that just amazingly startling is when you look at the population growth since 1970. As you can see, back then we were a country of 203 million people, and now we're about 320. Down here you were below or right at 300,000. You had a recession, but again, you had 100 and some odd million less people in there. So that's a very telling indicator in terms of really the relative strength in the jobs market. And I'm bringing this up because we have the jobs number tomorrow, which I'm going to talk about in a second. I want to play around just a little bit for you with this chart. I want to take us back to roughly the beginning of the present expansion, show you how weekly jobless claims stack up against the S&P 500. Now I'm going to invert this, so it's going to move in the opposite direction, meaning the line now goes up when weekly jobless claims fall. And I want to fold in the S&P 500 and show you some very interesting correlation. So certainly during this current expansion, there's been huge correlation between weekly jobless claims, or let's just say the jobs market in general, excuse me, and the stock market in the U.S. So tomorrow we have the jobs number. Last month we had a shockingly poor number with 38,000. Now you want to add 35,000 to that to come up with 73,000, because 35,000 people were on strike with Verizon. They're all back to work. But since that last report, we've had jobless claims continue to fall, particularly for the reference week, which they use for the survey for tomorrow's number. The ADP private payrolls was up 4,000 from last month. That was announced yesterday with 171,000. What I pay a lot of attention to are the Institute for Supply Management, the employment components in their manufacturing and service sector monthly surveys, and they were both stronger. So they both point to higher jobs as well. So tomorrow I think we have a consensus estimate of somewhere around 170,000 jobs to be added. My best guess is, or let's just put it this way, I would not be surprised to see that number better than what analysts had expected. I don't think it's at all likely that we have a number below 100,000, let's say, or anything like what happened last month, based on some of the leading indicators that tell us what it should be. So I think it's going to be a pretty good number. The question is, how will the market react to that? Today, utility stocks tanked. They're very interest rate sensitive. Financials rose slightly. The dollar was pretty strong today. Those would be interest sensitive sectors, and of course in the dollar we're talking about a currency that move, essentially the latter two move up when interest rates go up, at least in this environment, and then utilities would go down when interest rates go up. So what I'm suggesting is that tomorrow's jobs number got discounted a little bit in the market today as potentially being a pretty good number. The question is, how will that weigh on the market overall if it happens? I got to believe on balance that it's probably a good thing. I think that there's a lot less Fed fear in the market today post-Brexit, therefore some good economic data I would think at the margin should be viewed as pretty good for the market. Excuse me. So let me finish up just with the usual S&P 500 chart and show you how that looks. We are really having a problem getting above that 2100. Today it closed at 20,000 or 2097.9. And as you can see, that 2100 has been quite the level of resistance for this market. You can see we're dealing with a downward trend. I think tomorrow's jobs number, and again, some of this sideline cash coming in, relatively weak sentiment, going from the fear of losing to the fear of losing out. It's possible to see us shoot above that trend line and again, make a bid for higher highs going forward. If it's a weak jobs number, one might argue, as I have in the past, that could be positive for the market if it comes in below expectations. Perhaps there's a number around 150,000 that would quell any fear that we saw a little bit in the trading in the sectors that I talked about that are so interest rate sensitive. That one's hard to judge based on Brexit coming into the scene now. So it would make sense to me, having given this a lot of thought, that good news really probably should be good news for the market going forward. And I think we'll find out tomorrow, because if it's on consensus, which is plenty to capture new entrants into the workforce, that's probably pretty bullish for stocks. If it's too good, you're going to see the probabilities for a Fed rate hike begin to ramp up this year. And we'll see how the market deals with that. I would say on balance, the economy the economic indicators are coming in mixed with, I think, a bias to the upside, and that's probably not a bad thing for stock prices. But we do have this technical resistance that we have to get through, and I will be here to keep you posted as we go along. Have a great day. Look for my weekend commentary where I kind of wrap up the week and hopefully give you something pithy to ponder. Thanks again, folks. Bye-bye.